Hi there, tax accountants. I hope all is well, and I pray that as you are viewing this video, that you're in the best of health and spirit. This video is reviewing Pearson's Federal Taxation 2024 Individuals Chapter 2, which covers the determination of tax. So as we learned in Chapter 1, there are several entities in the federal income tax system. There are tax-paying entities, which consists of individuals and corporations, and there's also flow-through, aka pass-through entity, which is our sole proprietorships, partnerships, LLCs and LLPs, as well as S corporations. So as it relates to individuals, each year there's over 160 million federal income tax returns that are filed by individuals. As we know, we learned in Chapter 1 that there's a formula for calculating the tax liability, for calculating taxable income. So as it relates to individuals, taxes are imposed on the taxable income of every individual. And determining the tax that's actually owed by the individual taxpayer, it's determined by applying a complex set of rules that makes up the income tax law. So in order for us to truly understand the income tax, then it's necessary to study the basic formula. So the basic formula that we covered in Chapter 1, we're going to go into it in more detail in this chapter to get a better understanding of its components. So because the income tax formula, it constitutes the basis of the income tax, the remainder of the book is essentially going to focus on an expansion of the formula. So in Chapter 2, our learning objectives includes the following: using the tax formula to compute an individual's taxable income, determining the amount of deductions from adjusted gross income, calculating the income tax for individuals, explaining the basic income tax rules relating to business entities, explaining the basic income tax rules of capital gains and losses, describing tax planning considerations from various tax matters, and describing compliance and procedural matters for filing tax return. So here, we're going to do an overview of the basic formula for calculating the income tax. So we start off with total income, and from there we subtract exclusions, deductions for AGI and from AGI. So we're going to take the time to essentially go through each of these. So most individuals compute their income tax by utilizing this formula that we see here on the screen. The formula in and of itself, it seems, relatively simple. However, the complexity of the income tax law results from some intricate rules that must be applied in order to determine the amounts that are going to be used by the formula. So here we see total income, but as we'll learn in Chapter 3 and as we'll learn in Chapter 4, in Chapter 3, it deals with gross income inclusions, and in Chapter 4, gross income exclusions. So as it relates to the total income, it's important to be able to determine which amounts are included for tax purposes and which amounts are excluded for tax purposes. So the tax formula is incorporated into the tax form, and on another slide, the next slide, we'll essentially see what this Form 1040 looks like. So here we see this Form 1040, right? In Form 1040, there's some differences, obviously, that exist between the tax formula that we see on the first slide and this Form 1040 as we see here. So one key thing to keep in mind is that, for example, some taxpayers, they're not required to report any exclusions. They do not have any non-taxable income on their tax returns, right? And there's a number of separate schedules that are used to report various types of income. So at the very least, all individuals are going to file a Form 1040. Each year, sometimes the makeup of the form, it changes based on tax provisions, tax reforms, and things of that nature. However, for the most part, each individual is going to file a federal tax return, and then depending on their situation, they might or might not have to utilize one of the various schedules that includes other information. So let's say they have other income, they have other taxes that they're subjected to and things of that nature, and then they can use the various schedules. And we can essentially see how the 1040 is broken out. On Form 1040, We start off here with the U.S. individual income tax return. It shows you the year, the filing statuses, which we'll learn a bit more about. We have single, married filing joint, married filing separate, head of household, qualifying surviving spouse. You check one box, and it's based on the information that pertains to you for the specific year. You would input your first name and middle initial, if any, as well as your last name. Your social security number would be to the right. If you have an ITIN and ITIN number, this information would be input here. If you are married, your spouse's information would be directly below that, as well as their social security number or ITIN. You would input your home address, apartment number, if any, city, town, or post office, the state abbreviation, as well as the zip code. If you are an individual who maybe you're a US citizen, but you are residing in a foreign country, and you would input the foreign country name, foreign province, state, or county, and the postal code. Here, there's also a presidential election campaign. You will choose this if you or your spouse want to donate $3 to go towards the fund. Then you would select the checkbox. There's this new provision on the 1040 digital assets. There's a lot of people who are selling cryptocurrency. So it asks if at any time during the year, did you receive as a reward or payment, or did you sell, exchange, gift, or otherwise dispose of a digital asset? You need to answer this question. Next is it relate to the standard deduction. As we'll learn a little bit later in this chapter, if you are a dependent and you had income, you might be required to file a return, or if your spouse is a dependent, or if your spouse itemizes on a separate return, or if you were a dual status alien. So these are some intricacies in the tax law, but we'll just keep it very simple. Based on your age, and if you're blind, there's an additional standard deduction. So you would check off this information. Next covers dependents. This is essentially if you have what's called a qualifying child, or if you have a qualifying relative. We'll look into a bit more of that. Here we have income, and we have the total amount from your W-2, any household wages. So 1 basically deals with any wages. 2, we have tax exempt interest, qualified dividends, IRA, pension. So this first section essentially covers income. In line 9, we have a total. Line 10, we have some adjustments to income. And then on line 11, we have our adjusted gross income. So here we see on line 10, this represents our 4 AGI deduction. And our adjusted gross income on line 11 is $110,000. And then line 12 represents our from AGI deduction. So we'll go into a bit more about that. So we started off with $122,000 worth of total income, $118,000 from wages, $4,000 from taxable interest, for a total of $122,000. We had deductions of $12,000. So therefore, our adjusted gross income was $110,000. Our from AGI deductions were $28,710. So we went from $122,000 of total income to $81,290 of taxable income. And then on the next page of the 1040, based on the taxable income, from there we calculate the tax. Maybe there's some child tax credits or any other credits that might apply. From there, we look at the payments. And after we look at our payments and refundable credits, we compare that to the total tax, and that ultimately determines whether there's a refund or if there is an amount that is owed. Then here, there's a third-party designee. This allows another person to be able to discuss the return with the IRS. Here, if you are mailing it, then it would be signed. If you are e-filing it, it would be electronically signed. And then if you are paying a preparer, then the preparer who filed the return, their information needs to be here: their name, their firm name and address, their signature date, their PTIN, which is essentially like a social security number for tax professionals, and the EIN number if necessary. So this is just a quick overview of the Form 1040. So as it relates to income, The formula includes terms, as we saw, such as gross income, exclusions, adjusted gross income, taxable income, gross tax, and tax credits. So in order to get a greater understanding of these, we're going to look at each term. So income, the term income includes both taxable as well as non-taxable income. And just keep in mind, the term income is not specifically defined in the tax law. However, it includes income from any source. As we see here, any income from whatever source derived. Its meaning is similar to that of revenue, right? So as a company, a business owner, revenue is essentially any income, any money that the company earns. So think of it in such way, right? But one key thing to keep in mind is that income, it doesn't include any return of capital. So let's just say you have a piece of property. Let's say you paid $10,000 for the property and you sold it for $15,000. The entire $15,000 is not considered income. Only the $5,000 is the gain is treated as income. So just keep that in mind. All right, and we have this extra example here. Bob sells a piece of property for $1,000. He has a cost basis. He pays $700 for that property. So therefore, Bob will only include the $300, the gain, not the $1,000. As it relates to exclusions, we'll learn in chapter 4, not all income is taxable. An exclusion is any item of income that the tax law says is not taxable. So Congress over the years, they specifically excluded certain types of income from taxation for various social, economic, and political reasons. So one key provision as it relates to life insurance. So life insurance is one of those things that is not considered taxable. So here are some other examples. We have gifts, welfare, certain scholarships, certain payments for injury, certain benefits for employees, certain foreign income, tax-exempt interest, Series EE bonds, medical saving account distributions, meritorious achievement awards, certain divorce payments for agreements executed prior to 2019, a gain from the sale of a home, Roth IRA distributions, as well as Social Security benefits. So this is essentially a list of some of the items that are excluded from income. And next we have our gross income items. So gross income is income that is reduced by exclusion. So in other words, it's basically all of the income from taxable sources, and that's reported on your tax return. Because obviously, if it's excluded income, then it does not need to be disclosed. It is not reported on your tax return. So the items listed in section 61A are shown in this table here. And in section 61A, keep in mind, it states that unless otherwise provided, gross income means all income from whatever source derived, including but not limited to the listed items of income. So even though an item might be omitted from this list, it doesn't necessarily mean that the item is excluded. So just keep that in mind. So one key thing to keep in mind, illegal income, right? Illegal income is not reported on this list, but illegal income is considered taxable. So here we just have some examples. We have wages. You work a job, you are an employee, you get wages. You're self-employed, a business owner, you have business gross income, any gains from the sale of property, any interest income. This is, passive income, any rental income, royalties, dividends, any alimony that you've received through 2018. The Tax Cuts and Jobs Act had a significant change to alimony payments. Annuities, life insurance proceeds, pensions, COD income, partnership income, IRD income, trust and estate income. All right, so these are just some examples. And next, as we pointed out, we have for AGI and we have from AGI deductions. So as it relates to the deductions for and from AGI, in general, taxpayers are allowed to deduct any expenses that first and foremost are specifically allowed by the tax law. So some allowable deductions include business and investment expenses generally, along with any personal expenses that are specifically provided for in the Internal Revenue Code. A great example of that would be charitable contributions. Most purely personal expenses are not deductible. So if you decide to take your family on a vacation, or you decide to enroll yourself or your child in a course just for leisure or for pleasure, that is purely personal. So therefore, it is not considered deductible. So as it relates to our deductions, deductions fall into two categories as it relates to individual taxpayers. We have deductions for adjusted gross income, and we have deductions from adjusted gross income. So in general, deductions for adjusted gross income are expenses connected with a trade or business. There's also contributions to certain retirement plans that might fall into this category. So most deductions from adjusted gross income are personal expenses that Congress has chosen to allow. So just keep that in mind as we are dealing with the from AGI deductions and for AGI deductions. So adjusted gross income is often referred to as AGI. This is a measure of income that falls between gross income and taxable income. So AGI is very important. Reason being is because when it comes to certain tax computations, especially those that impose limitations and potential exclusions, AGI is essentially used to determine the amount that is eligible. To be deducted. So a great example for AGI is anytime we're dealing with medical expenses. So we'll learn a bit more about itemized deductions. And for medical expenses, AGI is essentially the ceiling floor. Next, we have deductions from AGI. So Section 62 lists the deductions for AGI. So any allowable deduction that's not listed in Section 62 is a deduction from AGI. So keep that in mind. The deductions from adjusted gross income, it's one of the two. It's either itemized deductions or standard deduction. So you have to choose between the two, itemized deductions or standard deduction. So as mentioned, taxpayers, they generally cannot deduct personal expenses. However, Congress has allowed for taxpayers to deduct specific personal expenses such as charitable contributions, home mortgage interest, and medical expenses. Taxpayers have the choice of claiming either the itemized deductions or standard deduction. And the amount of the standard deduction, it ultimately varies depending on the taxpayer's filing status, their age, and their vision. If they're blind or not, then there's an additional deduction that is allowed. So as a practical matter, for most taxpayers, they'll generally take the standard deduction because it would be greater. So taxpayers with small amounts of deductible expenses, and they don't itemize, then they essentially just, are allowed to take the standard deduction. So an easy way to think of itemized deductions versus standard deduction is the standard deduction is essentially a set amount that the IRS allows you to keep tax-free based on your filing status and your age. And each year that amount is adjusted for inflation. And itemized deductions, on the other hand, is essentially a list of personal expenses that, as we just pointed out, is allowed to be deducted by Congress. And keep in mind, some of these personal expenses are subjected to a specific limitation. But as we move on and go through the other chapters, you'll get a greater understanding and have an opportunity to do some practical application of determining whether or not the standard deduction should be chosen versus the itemized deduction. So these are some examples of deductions for AGI: trade and business deductions, any reimbursed employee expenses, loss from property sales, rent and royalty deductions, retirement plan contributions, penalties from savings accounts, 1/2 of self-employment taxes, self-employed health insurance premiums, any alimony for agreements executed prior to 2019, any moving expenses for active duty military, repayments of unemployment compensation, certain jury duty pay, interest on student loans, and medical savings account contributions. So this is not an exhaustive list, but these are some of the deductions for AGI. And as pointed out, our deductions from AGI, taxpayers can deduct the greater of itemized deductions or the standard deduction. So as it relates to itemized deductions, as pointed out, this is essentially a list of personal expenses that Congress allows taxpayers to deduct, and some of them are subjected to a limitation, as we'll see. Medical expenses, taxpayers can only deduct amounts over 7.5% of adjusted gross income. So let's just say an individual's adjusted gross income was $10,000. In such case, they can only deduct any medical expenses that exceeds 7.5% of their adjusted gross income. So they can only claim medical expenses that exceed $750. Next, we have property, state, local, and real estate taxes. These are limited to $10,000 for all filing statuses. However, for married filing separate, it is limited to $5,000. Home mortgage interest is limited to $750,000 mortgage incurred 12/16/2017 and later. So after December 16, 2017 and later, the limitation is $1 million in mortgage just incurred before December 16, 2017. And then we also have charitable contributions, and charitable contributions are limited to 60% of adjusted gross income. And as it relates to the standard deduction, as mentioned, it is essentially, think of it as a set amount of money that the IRS allows you to keep tax-free before they determine how much tax needs to be paid. It is dependent upon your filing status, your age, and your vision, whether you are blind or not. So as a single individual, the standard deduction is $13,850, head of household, $20,800, married filing separate, $13,850, married filing jointly, $27,700. And from there, you add $1,500 to the standard deduction, $3,000 if you're married filing joint and both are blind for married taxpayers. So there's a maximum increase of the standard deduction for married filing joint individuals of $6,000. And the amount increases from $1,500 to $1,850 if an individual is unmarried. And again, these are the standard deductions for 2023, and it increases for inflation each year. Next, we have the disallowance of standard deduction. So this is in the event that the return is less than 12 months due to a change in an accounting period. If you are married filing separate, in the event that you are filing a married filing separate tax return, then both individuals need to choose the same deduction, even if the other deduction has a greater benefit. So if your spouse claims itemized deductions and you are filing married filing separate, both of you need to claim the same deduction. In addition, a non-resident alien is not allowed to claim the standard deduction. However, that is only if the resident country of that individual, there's a treaty with the IRS. Like there's a specific treaty for students and apprentices from India. If they are here, yes, they are a non-resident alien, but because of the specific treaty for students and apprentices that come from India, they are allowed to claim the standard deduction, much like a resident, a US citizen, or a resident alien for tax purposes. All right, so one of the key things as you are preparing a tax return relates to dependency exemptions. For many decades prior to 2018, generally individuals, they could deduct personal and dependency exemptions. So for example, in 2017, an individual could deduct $4,050 for himself or herself. And if obviously you're married, then you multiply that by 2, as well as an additional $4,050 for each dependent. However, the Tax Cuts and Jobs Act, TCJA, suspended this deduction for 2018 through 2025. So this part of the tax law might or might not change. We'll have to see. So despite being unable to deduct the exemption for such years, we still have to determine if someone qualifies as the taxpayer's dependent, whether they should be treated as a child or whether they should be treated as a qualifying relative. So qualification as a dependent, it has an impact on the taxpayer's filing status and whether or not a child tax credit or a credit for underdependence can be claimed. So it's very important. So in order to qualify as a dependent, an individual has to meet the definition of either a qualifying child or a qualifying relative. So both types of dependents, they must meet several requirements. So we have two tiers. The first tier is they have to meet all four of these criteria. First, they need to have a qualifying ID, social security number or ITIN number. Two, they must meet the citizenship test. Dependents must be a US citizen or national or resident of the US, Canada, or Mexico for some part of the year. They must meet a separate return test, which means they basically cannot file a return with someone else. And the individual cannot claim someone else as a dependent. So if they meet all of these four criteria, from there, we move up to tier 2 and we determine, are they a qualifying child or are they a qualifying relative? So in order to be a qualifying child, there's these four tests. There's the relationship test, the age test, the abode test, and the support test. So for the relationship test, eligible children include the taxpayer's children. This includes their biological, their adopted, foster, stepchildren, as well as the taxpayer's siblings. This also includes any half and step siblings, as well as any descendants of the above. So if the child is adopted, then they have to have been legally adopted or legally placed in that home for adoption. As it relates to the age test, a qualifying child must be under the age of 19, or there's a specific provision if the qualifying child is between the ages of 19 to 24. If they are a full-time student under the age of 24, then the age test is expanded. So a child is considered to be a student if he or she, if they're in full-time attendance at a qualified educational institution for at least 5 months of the year. So that's the key thing. And in order to be considered full-time, the student must carry the number of hours or courses that the educational institution requires for a student to be considered full-time. So for some colleges, it might be 12 credits. For another college, it might be 15 credits. So again, if they are above the age of 19, but under the age of 24, they must be in school full-time for at least 5 months. Next, we have the support test. So a qualifying child may not provide more than 1/2 of his or her own support during the year. So support is basically, dependent on whether or not the individual can actively take care of themselves for the most part. So this can be a little intricate area of the tax law because sometimes when individuals are in school, they are also working. So this is something that the individual would need to take the time to discuss with their CPA, their enrolled agent, their tax preparer, so that way the parent can ultimately determine whether or not that child is actually a qualifying child. So in the event, let's just say the child was 22 years old and they were not in school full-time, unfortunately, they do not qualify as a qualifying child. So then the next step is that they have to meet all 3 criteria for a qualifying relative. So with a qualifying relative, the qualifying relative with the relationship test, they must either be related to the taxpayer or reside in the taxpayer's household for the entire year. The term qualifying relative, it can be kind of misleading, obviously, because if an individual lives with the taxpayer, they don't have to actually be related to them. Right? The relationship between the taxpayer and the dependent, however, it cannot violate the local law. So just keep that in mind. So some individuals who meet the relationship test for a qualifying child, such as taxpayers' children, siblings, descendants of the children, they might also meet the relationship test for a qualifying relative. However, If a person meets all the tests for a qualifying child, is deemed to have that status versus the qualifying relative, that's something also, to keep in mind. So the next thing is the gross income test. So for 2023, the qualifying relative's gross income must be less than $4,700. So the statutory definition of gross income obviously is going to be used in applying this limitation. So any non-taxable scholarships, any tax-exempt bond interest, non-taxable Social Security, that's not considered. However, if that individual has a job, if they have rental income, any other source of taxable income, then that is factored in as it relates to the gross income test. And the last requirement for a qualifying relative is the support test. The taxpayer normally has to provide more than 1/2 of the qualifying relative's financial support during the year. So support basically includes any amount that's spent by the taxpayer, the dependent, or other individuals. Welfare and Social Security benefits that are spent on support, those even count, even though they're excluded from gross income. In the event that, it's a scholarship that's received by a son, a daughter, or a foster child, that doesn't count as support, however. All right, so there's definitely a lot of nuance as it relates to dependency exemptions. So it's very important to gain a great understanding of this. So as we pointed out, tier 1 criteria for dependency, each dependent must have a Social Security number or an ITIN. If they don't have a Social Security number and they only have an ITIN, then there are certain credits that they are not eligible for. They must be a U.S. citizen, U.S. national, or legal resident. The separate return test. The dependent cannot file a joint return with a spouse, or if the dependent files joint, only to obtain the refund of tax that was withheld. Qualifying child or relationship test, as we pointed out, the taxpayer's natural, adopted, foster, and stepchildren, taxpayer's sibling, half siblings, step siblings, any descendants of the above, and if they were adopted, there needs to be a legal adoption or the child was legally placed in the home for adoption. The age test, it must fall within at least one category under the age of 19, permanently disabled, or a full-time student under the age of 24. And again, the student is considered full-time if they're enrolled in a qualifying institution for at least 5 months and has a full course load. Next, for the abode test, they must have the same principal abode, the same home, for at least more than 6 months of the year. There's a bit of nuance as it relates to non-custodial parents. And then with the support test, the dependent can't provide more than 1/2 of his or her support. And we move on to the qualifying relative. As mentioned, a relationship test must fall within at least one category related to the taxpayer, does not have to live with the taxpayer, can be a qualifying child, parents, step parents, or in-laws. If they reside in the taxpayer's home for the entire year, the dependent needs only to be related to one spouse in a joint return, and relationship is not terminated by death or divorce once established. The gross income test, the dependent's gross income must be less than $4,700. And then the support test, the taxpayer must provide more than 1/2 of the dependent's financial support. And next, we have some tiebreaker rules for dependency. So more than one person can meet the requirements to claim someone as a dependent. So obviously that presents a challenge. So there's these tiebreaker rules. And these tiebreakers decide who is allowed to claim the dependent in such situations. So if more than one taxpayer can potentially claim, then the possible claimants are prioritized in order of the greatest claim to least. So the taxpayer who can claim under qualifying child rules versus other relatives. So if a taxpayer can claim a dependent as a qualifying child versus a qualifying relative, then the individual who can claim under the qualifying child rules is allowed to claim the child. If there's parents, parents have greater claim over non-parents. And if one or two don't apply, then the exemption goes to the taxpayer that has the highest adjusted gross income. And sometimes There's a group of people who collectively provide over 1/2 of an individual support, but no one person provides over 1/2 of it. In this case, there's eligible members of a group, and they may designate one group member to claim the individual as a qualifying relative. So each eligible member, other than the taxpayer that claims a qualifying relative, has to agree in writing to the designation. So there's a specific form called Form 2120, and this is the multiple support declaration. And this form essentially enables a taxpayer to claim a dependent in situations where the taxpayer does not provide over 1/2 of the dependent support. So this is definitely really important. So let's just think of a parent who is elderly and they have multiple children, and multiple children are taking care of the individual, and obviously, this can have an impact. And this is an example of the form, multiple support declaration, the name shown on the return, the calendar year, the eligible person for which the support is being provided. And then here you see I've signed a statement from each eligible person waiving his or her right to claim this person as dependent for any tax year that began in the above calendar year. Now, when we start to deal with children of divorced or separated parents, this is generally a dependent of the custodial parent. However, the child is a dependent of the non-custodial parent if the custodial parent, the parent with whom the child lives with, or the parent with whom the courts have given legal custody, signs a completed Form 8332. So the signed form has to be attached to the non-custodial spouse's return for each year that the child is claimed as a dependent. So in the case of a divorce of a separation, the custodial spouse probably, obviously, they'll be reluctant to relinquish the right to claim the child as a dependent. So in such case, they obviously need to negotiate and come to an agreement for who can claim which child. All right. So as it relates to credits, we have what's called refundable credits, and we have what's called non-refundable credits. So with our credits are essentially very important, reason being because they determine how much an individual needs to pay back, or they have an impact rather on how much needs to be paid back. So for our credits, these are a very important factor, again, in determining what an individual's tax liability or refund will be. So as it relates to our tax credits, here we see, refundable, right? So with our credits, they essentially allow you to claim a deduction, and they essentially allow you to lower your tax. So we have several credits here, as we'll see. Refundable credits, we have the taxes that have been withheld, payments made with extension, child care credit, the earned income credit, the excess Social Security tax, any overpayment of prior year tax, and estimated payments. So as it relates to these credits, both credits are basically directly subtracted from the amount of taxes that a taxpayer owes. And in this case, we have non-refundable credits. So refundable and non-refundable tax credits, they're both, as mentioned, directly subtracted from the amount of taxes that a taxpayer owes. This is in comparison to tax deductions. Tax deductions, on the other hand, are subtracted from the taxpayer's taxable income. So as we think about it logically, tax credits result in bigger savings, especially for lower income filers. So some examples of non-refundable credits include R&E credits, adoption expense credit, credit for the elderly and disabled, education credits, business energy, child dependent care credit, and the foreign tax credit. So there's a number of credits, and we'll start to go through a few of them so you can get a greater understanding of the benefits of claiming credits. So as it relates to the child tax credit, taxpayers can claim $2,000 credit for each qualifying child, or $500 each for other dependents, qualifying relatives. And these are considered partially refundable. So the same definition for a qualifying child, except the child has to be under the age of 17. So once your child or a relative is above the age of 17, then they are not allowed to claim this credit. So the credit is reduced $50 for every $1,000 or part thereof over 200,000. And that essentially applies to every filing status. And if the individual is married filing joint, if their income is above $400,000, then the credit is reduced $50 for every $1,000. And it might be partially refundable. The refund is limited to the lesser of 15% of the taxpayer's earned income in excess of $2,500, or $1,600 if the taxpayer has one or two qualifying children that are under the age of 17. So that's a very big credit, because obviously it relates to whether you have a qualifying child or a qualifying relative. And one of the most important things as it relates to filing taxable income is determining the tax. So after taxable income is computed, the next step is to determine the gross tax. So most individuals determine the amount of gross tax by looking at the tax table, right? So this method basically allows the taxpayer to arrive at the gross tax without the need for multiplication, and it basically helps to simplify the computation and reduces the numbers of errors. So in order to determine how much tax an individual is subjected to, then it is based on filing status. So there are 7 tax brackets applicable to individual taxpayers. There's 10%, 12%, 22%, 24%, 32%, 35%, and 37%. So as we learned in chapter 1, these rates are progressive in that as taxable income increases, the taxpayer moves into a higher tax bracket. So as we discussed, the marginal tax rate. So the income level at which the higher tax bracket begins depends on the taxpayer's filing status. There's 5 different filing statuses, but only 4 rate schedules in our tax tables, because when we're dealing with, we'll learn about surviving spouses and married filing joint individuals, they essentially use the same tax pay. So here we have this flow chart to determine the filing status. So the first question is, was the taxpayer married as of the last day of the tax year? If yes, then we have to factor in, was the taxpayer an abandoned spouse? If yes, we factor in, is the taxpayer a U.S. citizen? No. Was the taxpayer married as of the last day of the tax year? It was no. Then we have to ask, did the taxpayer's spouse die during the tax year? So if the individual was married, so we'll follow both flow charts. We'll start off with yes, the individual was married. If the individual was an abandoned spouse, no. Were they married filing separately, or they can choose to be married filing joint? So was the taxpayer married? We'll say yes, but they were abandoned. If they're a U.S. citizen, no, then they have to file as single. If they were a U.S. citizen, then there's some other nuance. There's a potential that they could be treated as head of household, or that they can be treated as single. So when you're filing a tax return for an individual, this is at the very least, one of the most important things for you to determine what is the proper filing status, because obviously it has a direct impact on their standard deduction, their itemized deduction limitation. Remember, you choose the greater of the two. It also has an impact on which credits they can take. For a married filing separate individual, if you are in school, you can't take that credit. You don't get earned income credit. So there's several credits that you do not get if you choose married filing separate. And then there's also head of household. So there's a lot of nuance when it relates to determining the filing status. So as I mentioned earlier, there's this surviving spouse, or it's also referred to as a qualifying widower. So this is in the event that you are married and your spouse passed away during the year, then you get to claim the taxes based as though you were married for the entire year. And a surviving spouse, this is if you were not only married, but you also had children. qualifying children, qualifying dependents. So therefore, you claim the surviving spouse criteria. So what that simply means is that a widow or widower can file a joint return for the year that his or her spouse dies if the widow or widower doesn't remarry. And then 2 years after the death, the widow or widower, they can file a surviving spouse only if they meet specific conditions. So the specific conditions are as follows. They cannot be remarried by the end of year 2. They must be a U.S. citizen or resident, and they must have a dependent living at home with the taxpayer paying over 1/2 of the expenses for the home. So again, these things, they start to make more sense with practice. You look at the individual situation and keep in mind, an individual situation might change from year to year. Obviously, if they're married, then, the options are either married filing joint or married filing separate, or in the case, there's a caveat if the spouse abandoned them and they didn't live together for the last 6 months of the year. In such case, then they would claim, or there's a potential rather to claim, the head of household filing status. In the event that someone is unmarried, they will either file as single or head of household, depending on if they have a qualifying dependent or relative. So next we move on to children with unearned income. So a child may own investments that generate unearned income, such as interest and dividends. So sometimes, parents, they decide to set up accounts for their children to earn passive income. They have their own portfolio. And because the child owns the investments, the unearned income is taxed to him or her. So if the child's tax bracket is lower than his or her parents' tax bracket, there's an opportunity to reduce the family's aggregate income taxes by transferring some of the parents' investments to the child. So obviously, Uncle Sam was very smart and realized that this was an issue, because obviously this opportunity enhanced when some or all of the child's unearned income was offset by the standard deduction. So that is why we have what's called the kiddie tax. So this basically limits this tax avoidance opportunity. So children with earned or unearned income are required to file their own tax return if otherwise over the filing threshold. So the standard deduction is limited to the greater of $1,250 or the dependent's earned income plus $400, not to exceed $13,850. So kiddie tax, this is if the child is under 18, 24 in some cases. Some of the child's unearned income is taxed at the parent's marginal tax rate. So if the child is less than 18, the kiddie tax applies to the unearned income that is greater than $2,300. If the child is 18, they have to file kiddie tax if the earned income is less than or equal to 1/2 of their support and their unearned income is greater than $2,300. If they're 19 but less than 24, they have to pay kiddie tax if they're a full-time student and their earned income is less than or equal to 1/2 of their support, and unearned income is greater than $2,300. So there's a lot of nuance as it relates to the unearned income. However, this applies again in situations where the child has a certain amount of income, and therefore the tax law requires certain children with unearned income to calculate their tax in a special way. So you might not always see this in the profession, but it does happen. So it's important to be aware of this special provision in the tax law. All right, next we have the treatment of capital gains and losses. So capital gains and losses, these derive from the sale or exchange of capital assets. When there's net long-term capital gains, they are taxed at a lower rate versus an ordinary income. So capital gains are taxed at favorable rates versus ordinary income or ordinary gains, which are taxed at your ordinary tax rate. So net short-term capital gains are taxed as ordinary income. So there's, some tax planning opportunities here. If an individual has certain, stocks or something that they want to sell, they will plan to determine, hey, what will be the benefit if I sell it now versus if I decide to sell it. And long term is anything over 1 year and 1 day. Short term is anything that is sold within 1 year and 1 day. So capital assets are a general trade, business, or investment property that are not inventory. So inventory is essentially anything for resale. And net capital losses are deductible only up to $3,000. So excess capital losses can be carried forward. So there's a benefit of having capital gains over ordinary gains. However, there's a disadvantage of having capital losses over ordinary losses. Capital losses, the maximum amount that can be deducted each year is $3,000. However, if you have an ordinary loss, you can claim the full amount in the year of the loss. So let's say we have an example of a $9,000 loss. If the loss is a capital loss, it will take 3 years to write it off, $3,000 each year. However, if it is an ordinary loss, you can claim the full $9,000 in the year the loss was incurred. But just keep in mind with capital losses, you don't lose them. They basically carry forward. If you die, unfortunately, they don't carry forward to your next of kin. All right, so just carrying on with the capital gains. So capital gains and losses, they've been accorded favored tax treatment since 1922. So as we pointed out, the favored tax treatment, it essentially means that capital gains are taxed at a lower rate than ordinary income. So capital gains are taxed the following maximum rates depending on the taxpayer's AGI, adjusted gross income. So 0% for adjusted gross income that's less than $44,625, 15% for AGI between $44,625, and 20% for adjusted gross income that exceeds $459,750. And as we see here, if you're married filing joint, then those numbers increase. So considering, these nuances in a tax law, there's significant opportunities to do some tax planning to shift income. So because of the progressive tax system, families, they can often reduce their overall taxes by shifting income to family members who are in lower tax brackets. So we have, shifting income. You can maximize your itemized deductions. You can determine if married filing joint versus married filing separate work better. And you can also split income. So splitting income consists of creating additional taxable entities, potentially a corporation, to reduce an individual's effective tax rate. So these are some opportunities for tax planning considerations. Next, we considered who needs to file, right? That's one of the key things with taxation. It needs to be compliance and procedural considerations. So in general, an individual must file an income tax return if his or her gross income exceeds his or her standard deduction. And this also includes the additional standard deduction that's due to age or to blindness. However, the fact that the individual owes no tax, that doesn't necessarily mean that they don't need to file a tax return, because the filing requirement is based on gross income, not taxable income or a tax liability. So just keep that in mind. So taxpayers under the age of 65 must file if gross income exceeds the following levels, even if no tax is due, as just mentioned. So single individuals, if their gross income exceeds $13,850, married filing joint, if the gross income exceeds $27,700, surviving spouse, again, this is a widow or a widower, if their gross income exceeds $27,700, if someone is married filing separate, if their gross income exceeds $5, they need to file. And for a head of household, if their income, gross income exceeds 20,800. So an individual is required to file an income tax return in 3 situations, even if their gross income is less than the applicable amount shown above. So if the taxpayer received advance payments of earned income credit, if the taxpayer has self-employment income that is greater than $400, if the taxpayer who is claimed as a dependent by another and has unearned income greater than 1,150, or their gross income is greater than the standard deduction, or if a taxpayer owes the additional Medicare tax, which is 0.9%, or 3.8 net investment income tax. So based on these situations, even though the individual's gross income is less than the applicable amount based on a standard deduction, they have to file a tax return. So these are just some of the due dates. There's due dates and then there's also extensions. So tax returns for individuals and C corporations are generally due on the 15th day of the 4th month following the close of the tax year. So for calendar year taxpayers, that's April 15th. And again, this applies to both individuals and C corporations. For partnerships and S corporations, their returns need to be filed by the 3rd day of the 15th month, or the 15th day rather, of the 3rd month after the close of the tax year. And again, partnerships and S corporations, these entities are considered pass-through entities. So to ensure that individuals have the necessary flow-through information from the pass-through entity, the partnership and the S corporation, which issues the K1, the K1s are due a month before the individual returns are due. In the event that the due date falls on a weekend or a national holiday, the due date is moved to the 1st business day following the due date. There's also extensions. So individuals can get an extension for 6 months. Partnerships and S corporations can get a 6 or 7 month extension. So individuals is generally due April 15th. If you get a 6 month extension, then the tax return would be due October 15th. For partnerships and S corporations, the tax return is due March 15th. So with an extension, it will be due September 15th. And as it relates to the Form 1040, so as mentioned, individuals use Form 1040 to calculate and report their federal income tax. So in addition to the individual's name, address, and social security number, the form asks for the filing status and information that's pertinent to the individual's standard deduction as well as their dependents. So Form 1040, it contains several dozen lines on which some individuals reports details about his or her, maybe their gross income, their deductions, and other items that affect the additional tax due or refund. So some of the amounts are reported directly on the Form 1040, and some of them, they will essentially need to use a separate schedule. So the separate schedules, we have Schedule 1, Schedule 2, and we also have Schedule 3. So Schedule 1 reports sources of income that's not reported on Form 1040. So for example, someone has a business, that information is reported there, the net loss for a business or for forming. You'll also report any other income for, let's just say if someone has a rental property, things of that nature. So any additional income that's not reported on 1040, it would be picked up on Schedule 1. For Schedule 2, that essentially reports any additional taxes and tax prepayments. And for Schedule 3, that reports any various non-refundable credits, such as the child care credit, education credits. It also reports any taxes paid when requesting an automatic extension of time to file a tax. So as it relates to forms that are filed with the IRS, there's a significant and expanding relationship between computers, tax returns, taxpayer identification system, and information returns. So if we think, to back in the day where a lot of things were manual, pen and paper, we now live in this technological age where a lot of this information is electronically filed, electronically stored. So the IRS keeps records based on taxpayer identification numbers, and this is our social security number or our ITIN, individual taxpayer identification numbers. So an individual taxpayer reports information based on their social security numbers, whereas businesses, they utilize EINs, which are employer identification numbers. And these are essentially used by, again, corporations, other taxpayers, and tax-exempt entities. So individuals who employ others have both a social security number, and then they also have an EIN number, because again, they're not just a taxpayer, but they're also an entity. So the need for accurate information is obvious. So some major information forms are reported below. So if you have a job, you get a W-2. This reports wages and salaries. 1099-G, this is if you receive certain government payments. 1099 DIV, this is if you receive dividends and different distributions. 1099 miscellaneous is if you receive miscellaneous income over a certain threshold. 1099 INT, this is if you receive interest income. 1099B, this is if you have sales of securities. These are proceeds from broker transactions. And then 1099Rs, this is essentially if you had a distribution from a retirement plan. So there was a lot that we covered in chapter 2, and this brings us to the end of chapter 2, the determination of tax. We essentially use the tax formula to compute an individual's taxable income. We looked at some information of how we determine the amount of deductions from adjusted gross income, how one would calculate the income tax for individuals, explaining some of the basic income tax rules relating to business entities, explaining the basic income tax rules of capital gains and losses, describing some tax planning considerations for various tax matters, and describing the compliance and procedural matters for filing tax returns. So this brings us to the end of chapter 2, the determination of tax.